Hello, greetings to everyone. Nehemiah here again, and today we are going to discuss the tutorial set one for investment fundamentals. So I want to use like 20 minutes, 20 to 30 minutes to complete this. So we are going to move at a faster rate. You see, I told you guys that this semester, what I'll be doing is that I will solve them, and then when I come here, I'm just going to present the answers and then explain them how I arrived at this answer. Last semester, what I was doing is I'll come here and come and solve everything again, and to make the video so long, right? So I'm not going to do that this year or this semester. What I'm going to do this semester is after solving, I come in and then I'll come and then explain how I arrive at the answer. So this is it. This is the tutorial set one, and we are going to discuss this so fast, or very fast. All right. So first question is asking that we should define investment and discuss the overall purpose why people invest, or the overall purpose people have for investing. So basically, an investment is the current commitment of resources for a period of time in the expectation of receiving future resources that will compensate the investor for the time the resources are committed, the expected rate of inflation, and the uncertainty of future payments. That is the risk, right? So if you have all these in your definitions, then you are going to get your full marks. That's what it is told us. So an investment is the current commitment of resources. You are going to commit some resources. This is basically what we've done so far in our lectures. So if you watch the lecture videos, I'm not sure you should have any problem with this tutorial because this tutorial covers whatever we've done in the first uh, session of our slides, of our lecture. So it is basically the commitment, right, of resources for a period of time, expecting to receive future resources that will compensate the investor, or that will compensate us for the time that we've committed the resources, the expected inflation rate, and also the uncertainty of future payments, right? Then we move on. 1B is asking that we should outline the differences between savings and then investments, right? So for savings, for example, we are only putting the money down and then recouping it back later. We are not getting any kind of interest or income from it, right? But for investment, sorry, we are what? Trying to secure an asset that will give us some returns and also get some kind of capital appreciation if necessary, right? So we can see here, savings means putting or setting aside resources to meet a future need. But with investment, the investor receives compensation for the time the resources are committed and the expected inflation rate. Also, savings does not require any transaction with brokers or dealers, but investment usually require transacting with brokers or dealers. Then, savings also does not involve the purchase of real or financial assets, but investments involve either buying a real or a financial asset or both, right? So in savings, you are not going to buy any kind of asset. You are just going to put the money down somewhere. Whilst for for investment, you are going to buy those assets so that you will be what, able to expect some kind of return from it. All right. So here, this is asking what determines what determines the returns of financial security. So what actually determines the returns, or what you are going to get on financial securities, are basically the market risk, right? What actually will happen and then will affect the whole market as a whole, the market risk, and then also the size of your the size, right? So stock with smaller market capitalization tend to perform better. And also the value, right? And also not forgetting the profitability of it will also determine the returns on that security. All right. So basically that is it for question C, right? So we can just look into this. So what determines the returns of financial securities, the market risk, and then also the size. So if the market, if it has a small market capitalization, it's assumed that it have less investors. So people are going to invest in that, what, increase the returns and stuff, and then the value too, and also the profitability. All right, let's move on to B. So D is asking, explain the term diversification. I remember in our lecture one, we spoke about this and why diversification is useful in investment decision-making process. So basically, diversification is an investment strategy that involves spreading investments across various asset classes, industries, or geographic regions to reduce risk, right? It is based on the principle that different assets often perform differently under the same market conditions. So because we are diversifying, losses in one area can be offset by gains in another, right? And diversification is useful in investment decision making because it also minimizes the impact of the impact of poor performance for any single investment and reduces overall portfolio volatility. It also improves risk-adjusted returns by ensuring a balanced mix of investments. Diversification helps investors to achieve more stable and consistent long-term financial outcomes. Right. So this is self-explanatory here. Because we are investing, we are diversifying our investment. We are going to what reduce the volatility, which is how the portfolio will be fluctuating anyhow. We are going to reduce that. We are going to also minimize the impact of poor performance. So if let's say one particular asset is not really performing well, the other one that is performing well will what? Balance it. Right? So that's basically it here. And then the E is asking, explain with examples where necessary the three broad reasons for investing. Remember, the three broad reasons for investing is what? We are investing for income, we are also investing for capital preservation and also for capital appreciation, right? For income means that you want to gain some kind of regular stream of money from that side. Whilst for capital preservation is we want to maintain the kind of buying power or purchasing power our money or our money will be having. And also for capital appreciation is more or less like we've been able to increase that value of either the money. Yes. So this is explained here that for income returns, many investors seek to generate regular income through their investment. This is often achieved by investing in assets that provide dividend or interest payments. For example, stocks that pay dividend or bond that yield interest can provide a steady stream of income, which can be particularly important for retirees or individuals looking to supplement their earnings. Income returns help investors meet their ongoing financial needs while maintaining their investment portfolio. So this is for the income returns and also for capital preservation. Capital preservation is key for investing, especially for risk-averse individuals, those who don't really like to take bigger risks, or those nearing retirement. This strategy focuses on protecting the initial investment from loss while allowing some level of return. Investors may choose safer assets such as government bonds or money market funds to ensure their capital remains intact. For instance, someone's savings for a down payment on a house may prioritize capital preservation to ensure that the funds are available when needed without significant risk of loss. which means that when he needs the money to buy the house, he will still be able to buy it, right? Then capital appreciation. Capital appreciation refers to the increase in the value of an investment over time. Investors seek capital appreciation by purchasing assets that are expected to grow in value, such as stocks, real estate, or mutual funds. For example, if an investor buys shares of a company at $50 and later sells it for $75, and the increase represents what a capital appreciation. All right, so let's go to question 2. Question 2 is saying that explain the following, which is we should explain real estate, real asset, and then financial asset. So basically, real asset is that like it's more of the tangible assets, which was explained in session 1. It's more of the tangible assets, which can be plant property, equipment, and those kind of stuffs, right? So real assets are tangible assets and intellectual property that have productive capacity, but financial assets are just claims, but do not directly contribute to productivity, right? So an example here is real assets can be land, building, equipment, patents, and goodwill. And financial assets are currencies, derivatives, stocks, and then bonds. 3, how do you understand the term portfolio? So basically, portfolio is a collection of assets of different classes. That's it. So portfolio is basically a collection of assets of different classes. Right, B, investors make two main types of decisions in constructing their portfolio. Outline and explain them. So in constructing a portfolio, what investors normally looks at is what? Asset location and also security selection. So asset location is just a decision to invest in different classes of assets, right? So whether you are going to invest some of your capital in stocks, in bonds, and then also in gold, right? While the security selection is selecting a particular deciding to invest in a specific financial security in an asset class. So let's say you choose stocks, for example. Are you going to invest in Google, Apple shares, Tesla, and those kind of stuffs, right? So security selection is more into selecting a particular kind of security in the asset class, right? All right. So 3 is C. Briefly explain the importance of asset allocation, right? So you understand that asset allocation is what the decision to invest in different types of assets. So basically, this help us to what reduce risk. So if you know your streams of income, whether your income is stable or is not stable, you will know the kind of um, you know how to construct or the kind of assets you are to invest in, right? So basically, one of the importance is to reduce risk, and also asset allocation helps in explaining 90% of return variability over time. So how the your portfolio will be shaking and moving around if you have a good kind of portfolio, as in you actually risking well or putting the right classes of assets in your portfolio would what help in explaining how your returns will be. So D is saying that briefly explain the various risk management strategies. Right. So the various risk, this was also explained, I think, in the first session. Right. We have the risk avoidance. So risk avoidance basically involves taking proactive measures, eliminate potential risk entirely. Right. This strategy is often employed when the risk is deemed too significant to tolerate. Right. So for example, a company may choose not to enter a volatile market or discontinue a high risk product line. While this approach effectively eliminates certain threats, it may also result in missed opportunities because you are afraid of risk and you won't enter. You tend to what miss opportunities, right? So that's it for the risk avoidance. And the risk anticipation is the risk anticipation focuses on predicting potential risk. You know that whatever you are going to do, there will be some kind of risk. And before they occur. So this strategy involves continuous monitoring of the environment and conducting thorough analysis to identify emerging risks. By anticipating risks, organizations can implement preventive measures or contingency plans to mitigate their impact. So this proactive approach helps in preparing for uncertainties and reducing the likelihood of adverse events. It kind of going so fast. So we also have risk reduction. So risk reduction aims to minimize probability or impact of identified risk rather than eliminating them entirely, right? So organizations implement various measures such as improving process, enhancing training, or adopting safety protocols to lower the frequency and severity of risk. For instance, a manufacturing company might invest in better safety equipment to reduce workplace accidents. Whilst while risk reduction does not eliminate risk, it what reduces risk. So risk transfer is also there where there is a risk transfer. So what this does is that the investor will purchase some kind of insurance portfolio to transfer the risk from him to the insurance company, right? So here, risk transfer involves shifting the potential impact of a risk to another party, right? So I think it's self-explanatory. So he is saying that we should elaborate the individual investor's life cycle. We spoke about this in session one or session two, where we have the accumulation phase. So the accumulation phase is the early middle years of career, where we are attempting to satisfy immediate and long-term goals, right? So our immediate goals can be buying a car, marriage, and house, whilst our long-term one can be retirement plans, then our children's education needs. So we actually have a small net worth. We don't really have money like that. We have not reached any of the phase. I've not even entered the phase yet. So here, debts may be heavy, right? And long-term investment horizon means usually willing to take moderate high risk in order to make above average return. So here we take more risk. So this is basically what we've been doing in our lectures. So if you have been following the lecture, if you didn't have problems with it, we also have the consolidation phase, which is the past career midpoint. Here you have paid off much of your accumulated debt that you were owing in the accumulation phase, and then earnings now exceed the living expenses. So the balance can be what invested, right? And then the time horizon is still long term because you are not that old, right? So moderately high risk investments are still attractive. Our long-term goals is what? Retirement, and then our short-term goals now are vacations and then our children's education needs. Then we have the spending phase. Usually begins at retirement. Yeah, no, you save money, a castle be discount, and yes, I will be tiama. But so usually savings before prudent. So you save and then now you are spending now. Living expenses covered by social security and then retirement plans. So now whatever you be, your expenses Lankasa will be covered, and then there can you have to chop. Changing emphasis towards preservation of capital, but still want investment value to keep pace with inflation. Then the gifting phase. This can be concurrent with spending phase. If resources allow, individual can now use excess assets to provide gifts to others, right? Individuals or organizations. Estate planning becomes important, especially tax consideration, right? So now, question 4 is saying that is deflation bad? Briefly explain. So def, deflation is the persistent decrease in the general price level of all goods and services in the economy. Inflation is bad for the whole economy because it can lead to reduction in production, rise in unemployment, and also poverty level. Rise in hoarding, as in people keeping their stuff because the price is still reducing. And rise in deferring consumption, and consequently a fall in GDP. So why do pensions funds sometimes earn negative real interest rate? So pension funds earn negative real interest rate when the rate of return of the financial asset in which they are invested is lower than the inflation rate, right? So let's say you invested at a rate of 10%, and at the time of recouping, the inflation rate is around 15%, right? You're going to earn a negative. So when the real interest rate is negative, pensioners lose their purchasing power, and that is true. So what is the investor's required rate of return? Basically, the investor's required rate of return is the minimum compensation that you are supposed to get on an investment. So what this means is that if you don't get anything on investments, you should get something, some local fee. So that's the minimum or the investor's rate of return. So the nominal risk-free, this is an example here. It is another question. The nominal risk-free rate is given as 10%. The risk premium for investing in a financial asset, X is given as 5%. What is the expected rate of return? I remember expected rate of return in our session 1, right? Investors rate of return, expected rate of return, sorry, is going to be 1 plus the nominal risk-free rate, right? The nominal risk-free rate, all into brackets, times 1 plus the risk premium, all minus 1. That's the expected returns. So it's equal to the expected. So in this question, we were given our nominal risk-free rate to be 1%. So 1 plus, it was 10%. So 1 plus 0.1 times, then the risk premium was 1 plus 0.05 because it was 5%, all minus 1. When we do this, we are going to get 0.155. You can try that. That's why we arrived at this. All right. So here, discuss the 3 components of an investor's required rate of return. So the 3 components are the risk-free rate that compensates the investor for deferring consumption, the inflation rate that compensates the investor for losing purchasing power. Then we also have the risk that compensates the investor for taking an extra or additional risk. Then why is the real risk-free rate usually positive? Can it be negative? Yes, it can. Remember, we were having this formula here. I told you during the session that it is a formula. So as far as it's a formula and it is concerned, it can be so this I, which is a nominal risk-free, a nominal risk then R plus the phi. So here, this I being the nominal interest rate, and then we have the real interest rate to be R. Then we have the expected inflation rate, which is the pi. So expected inflation rate, the real interest rate, and we have the nominal interest rate, right? So basically, if this is, let's say, 3, This is no, if this is let's say -3, and then this is 2, basically this is going to be -1. This is going to be -1. Right. So that's the same thing. That's what they are trying to ask here. That's what they are trying to ask here. That why is the risk-free rate usually positive? Right? Can it be negative? So, for example, this is the risk-free, which is R here. Right? The real risk-free is R here. So if in case inflation becomes, let's say, -5, inflation becomes, let's say, -5, and then our nominal interest rate becomes, let's say, let me see, let's see, 1. So R will become, so when it's +5. Yes. So if this is +5, if the expected inflation rate is +5, and we want to find R now, R will be equal to 1 minus 5, which is going to give us -4. So it can be. So look at something here. So real risk-free rate is usually positive because savers always prefer compensation in order to give up the right to consume today, and borrowers are willing to pay to be able to spend more than their current resources allow. However, the movement of the inflation rates can make it negative. That's what I just showed here, that the movement of the inflation, the expected inflation, can make it negative, right? So for instance, when an investor commits resources, that promises a fixed return of 10%, right? And then fast forward, at the time of recoup, inflation is around 54%, right? Doing this arithmetic, the investor will what? Will 44. The investor will 44.1% real interest rate suggests that investor has lost purchasing power, because at the time the investment was bringing up 10%, and now inflation rate is 54.1%, which shows that the inflation is higher than the fixed. So as far as the inflation is higher, then we are going to what? Lose purchasing power. That's what I just explained here, but I explained with different extent. So question 6. I explained this in the lecture, so you can go there and then get more explanation. So question 6, list and explain some issues that an investor must consider when investing. We've spoken about this. So the investor has to consider his risk tolerance. So if the investor is willing to accommodate or take in more risk, then he can choose to what? Invest in high risky kind of assets, right? So understanding one's risk tolerance is essential for making investment choices that aligns with personal comfort levels regarding potential loss. Investors need to assess how much volatility they can withstand and choose investments accordingly, right? For instance, a risk-averse investor may prefer bonds or dividend-paying stocks, while a more risk-tolerant individual may opt in for growth stocks or cryptocurrency. So you also have the investment goals too. So clearly defining what you need for your investment also what make you know your investment decision. So if you're investing towards uh, income returns, you will know what to do. Capital appreciation, you know what to do. And also for capital preservation, so you know what to do. And also whether you are saving for retirement, and also funding education or aiming for short-term gains too, right? This will help you what? Select the appropriate investment vehicles and strategy. So this is how self-explanatory. And then the time horizon. How long do you want to commit your resources, right? So if you're investing in the short term, expect that you have a high risk. So the time frame for investing significantly influences asset selection and risk management. Longer time horizon generally allow for more aggressive investment since there is time for recover from market fluctuations. Conversely, shorter time horizon may require a focus on liquidity and capital preservation to ensure funds are available when it. We also have the market condition. So investors should also consider the market conditions, the trends, right, before committing the resources. So factors such as interest rates, inflation, geographical event, and also this can impact in the investment performance. So you have to stay informed about these conditions, right? These are all embedded in your investment decision making. And then the diversification. So to mitigate risk, investors should consider diversifying their portfolio across different asset classes, sectors, and geographic regions. This strategy helps reduce the impact of poor performing assets or securities. You also have to look into the legal regulatory factors. So what kind of investments are allowed and are not allowed, right? So understanding the legal and regulatory landscape is vital as it can affect investment choices and potential returns. Investors should be aware of any restrictions or requirements related to their investment, especially in foreign markets or specific asset classes. So B, some investors tend to invest in Ghana in the Ghanaian financial markets and they have approached you to obtain advice. As an investment student, what are some of the code of ethics you must observe? So the code of ethics are the integrity, objectivity, professional competence, and due care, confidentiality, and professional behavior. These are all explained in the slides in the first session of the recording. So you can look into it and then get more insight. Then C, why did households and firms invest more in gold and yen prior to the US election? The reason is just because they see gold and yen to be a safe haven. So investing in that will at least help them to move away from any volatility that will happen in the US currency, right? So uh, what this basically means is that when they invest in gold and yen, they are likely going to maintain their capital as compared to they still keeping their money in the US currencies. So you can see household and firm invest more in gold and yen because gold and yen are safe haven assets which can preserve capital of investors. Supposing the US election forced markets more rich, consequently depreciating the value of the dollar. So D, what happened to the tech? Wow, what's happening to the tech stocks when COVID-19 vaccine was announced? Right. So when COVID-19 vaccine was announced, remember in our slide session, I even showed you something on trading view, where, for example, uh, Zoom's stock prices fell and Netflix also, their stock prices also fell, right? So their stock prices fell because their demand decreased. People did not patronize in tech firms, products, and services. Likely they did not, likely like they did when the pandemic was more intense. So this was explained, even I used trading view and stuff to explain this in our class, right? You can look into that session. So explain some investment constraints in the Ghanaian financial sector. So first one is the liquidity needs. I also explained this. Liquidity refers to the ease with which assets can be converted into cash without significantly affecting the market price. So in Ghana, investors often face that. So our lecture even told us that the stock that is like high, is like a bit liquid in Ghana here is the MTN shares. The rest, you can buy the shares, man, but selling them, yeah, same. So you can read this. In Ghana, investors often face liquidity constraints due to limited range of liquid investment options. Many investment vehicles, such as real estate or certain long-term bonds, may not offer quick access to cash when needed. This lack liquidity, this lack of liquidity can deter investors from committing capital to longer-term investments, as they may require immediate access to funds for personal or business needs. And time horizon, right? The time horizon for investments in Ghana can vary widely among investors, influenced by personal financial goals and market conditions. Many investors may prefer shorter time horizon due to economic uncertainties or the need for immediate returns. This preference can limit their willingness to invest in assets that typically requires a longer time commitment to mature, such as equities or infrastructure projects. Consequently, this constraint can hinder the growth of capital markets and limit access to long-term financial financing for business. Then we also have the legal regulatory practice, which we've explained already in this session. So the legal and regulatory environment in Ghana presents both challenges and opportunities. While government has made strides in improving financial regulations and enhancing investor protection, issues such as bureaucratic delays, unclear property rights, and inconsistent enforcement of laws can create uncertainty for investors. Additionally, recent regulatory changes aim at stabilizing the financial sector, such as increased capital requirements for banks can restrict lending capacity and limit access to finance for small and medium-sized enterprises. Then we also have rich economic indicators. So Ghana's microeconomic environment has faced challenges such as inflation, currency depreciation, and fiscal deficit, which can adversely affect investors' confidence. I hear that I intentionally explained it so that I wouldn't really be. So weak microeconomic indicators may lead to higher perceived rates, associated rates, risk investments in the country. For instance, higher inflation erodes purchasing power and can diminish real returns on investment. Furthermore, currency fluctuations can impact foreign investments and make it difficult for investors to achieve stable returns. So question 7, with regards to investment, what is the difference between tax-deferred accounts and taxable accounts? So tax-deferred accounts is more or less like an account that will be taxed later, right? Whilst taxable accounts will be taxed before the actual investment. So basically, tax-deferred account is a savings or investment account which tax is deducted as and when withdrawals are made. So when you are making withdrawals, that's when you will be what taxed. Whilst taxable account deductions are made when returns are earned. So each time you make returns, not only deduct. So for example, this is the question. Priscilla is approached with two different investment accounts, A and B. Account A is a tax deferred account and has average annual earning of 16% per annum, right? And then account B also have a pre-tax return of 16%, assuming the tax rate is 30%. If Priscilla has an initial capital of 20,000 to invest in one of these accounts for 30 years, compute how much she will have after 30 years if she saves in A and B. So basically here we are just going to talk about time value of money and then how taxes are impacted, right? So based on your computation above, advise Priscilla which account is worth investing in. So here, what is the primary lesson? What primary lesson have you learned as an investment student for these computations? right? So look at it here at the end in account A, because it's a deferred kind of business. So she will be taxed at the end when she's trying to withdraw. So first of all, we find the value of the 20,000 at the end of the 30 years, and we had 1.7 million and whatsoever, right? So now, if we are to take tax, which is 30% out of it, right? One minus, or you can either do uh, the 1.7 million times 0.7 is the same thing. You are going to arrive at 1.2 million. So you can see that if account A is having a deferred tax at the end when she's trying to withdraw, then she'll be taking home 1.2 million, right? But look at assets account B. So account B is more or less like whenever there is a return, then she will be taxed. So you can see the 16% return here will be subjected to tax. So we take tax out of it automatically, right? So we take tax first. So when after taking the tax, you'll be left with 0.112 as the return. And the 0.112 is multiplied by, or we find the time value of money using that same amount, and then we get what? 483,000. So you can see that since the first one will have a higher kind of money than the second one, then we are supposed to what? Invest in the first account. So it is worth investing in the tax deferred account. And then D, taxes have significant impact on income returns. Hence, it's always better to invest in what? A tax deferred account. Because if taxes will affect your returns now, then you wouldn't really have, or you'll be faced with lower income at the end. But if it's because the taxes will still be the same at the end, then I prefer you what investing in what a tax deferred account. So this ends our session for the answers for the tutorial set one. Soon I'll also do for set two and then set three. Then we move on. Hope you enjoyed this. Kindly like this video and also subscribe to the channel for more. See you some other time. Bye.